If you've been following the stock market recently, you're probably aware of the roller coaster that it's been on. This is a result of events that are rippling across the globe. My name is Mackenzie, and by the end of this video, you're going to know the 3 golden rules for investing during a dip. And while all of the events that I referenced during this video are happening right now, these tips will take you through investing during any market downturn or period of market volatility.
While unemployment is dropping, prices are up across the board, from groceries and gas to used cars and rent.
That's the sharpest year-over-year increase in 3 decades.
So let's get started. To give you a little bit of context, the Federal Reserve recently held a meeting in which they announced they would potentially raise the interest rates for the first time in almost 3 years. But why hike the rates now? Because businesses are reopening as a result of the vaccine rollout, as well as the stimulus package from the year before. There's an overall struggle to meet consumer demand. With production costs rising, the inflation rate for the year 2021 reached almost 7%. These anxieties have resulted in an overall market drop, so much so that the market has now entered correction territory. This is when the overall price of stocks falls 10% or more from their most recent high. Now, let's get into the nitty-gritty. On January 24th, the Dow Jones plummeted roughly 3,000 points and was down about 10% from its high on January 5th. Taking the baton the next day, the Nasdaq dropped 16% from its November high, almost hitting the 20% decline marker that categorizes a bear market. And to cap it all off, the S&P 500 dropped 10% following its high on January 3rd. So, with stock markets experiencing a continuous dip, how can investors like you or I take advantage of these conditions? Well, I'm glad you asked. In this video, I'll lay out the 3 rules you definitely need to know if you want to take advantage of this dip and come out on top. Although it's pretty much impossible to predict how the market will perform, the general rule of investing is to buy when the stock prices are low and sell when the prices are high. This rule is popular because, historically, markets always bounce back over time. In the end, investors who hold on to their stocks during a market decline tend to come out on top and make greater profits when prices rebound. But that's not to say that stocks won't fall into a deeper decline in the meantime, or that they'll all bounce back at the same rate and the same level as before. One way you can potentially come out ahead is by buying the dip, a strategy where you buy stocks at a low price following a recent high. If the fundamentals are intact and the stock was oversold, you could be getting a bargain. And if the price rebounds, you'll make a profit. While these are 3 rules that I like to follow, please bear in mind that I am not a financial advisor, and I encourage you to do your own due diligence and research before making any trades. Rule number 1, don't try to time the market. At the risk of sounding obvious, why is this the first rule? Because you can't. Unless you're Alan Greenspan, you cannot time the market. It's incredibly risky, has huge downside, and investors could be missing out on the best days in the market. This can result in significant losses. For example, according to JP Morgan's 2021 Guide to Retirement, missing the 10 best days in the S&P 500 between January 2nd, 2001 and December 31st, 2020 would have slashed your overall return by more than 50%. If you were fully invested, a $10,000 investment would have reached $42,000. Missing those 10 key days drops it down to $19,300. Even if you don't buy exactly at the bottom, buying during the dip will allow you to accumulate stock at a relatively low price per share. Rule number 2, follow the fundamentals. Unless you're engaging in short-term investment strategies, you'll want to follow the market fundamentals, which remain the same for long-term investments. This is why you've probably heard about the pros shifting away from riskier stocks right now. Instead of buying stocks on the face value at the time of the dip, you'll want to look into things like the company's profitability or earnings to try to determine what the value of the stock will be after the dip. This way, when a stock price sinks because of a market downturn, you can be confident that the stock's price will rebound as long as the underlying business remains sound. To give you an example, some blue chip companies were stable for years before the onset of the COVID-19 pandemic, and then prices dropped. As a result, this gave investors like you and I the opportunity to get into these huge corporations by buying stocks at a discounted price before their shares rebounded. This most recent downturn can present a similar opportunity. However, some stocks are cheap for a reason. Don't buy or hold stocks just because they're at a discount or because they're cheap. My final rule is don't mistake the forest for the trees. And by that I mean don't focus solely on buying the dip. If you focus only on buying stocks at a discounted rate as a result of the dip, you could be missing out on huge returns from companies whose prices haven't dropped but are still experiencing tremendous growth. For example, while the broader market is experiencing a downturn right now, energy companies that drill for oil and gas are experiencing double-digit growth this year. KLX Energy Services is up 60% year to date, while BPT, a U.S. oil and natural gas royalty trust based in New York, is up 58% for the year. So instead of focusing solely on buying cheaper shares of falling tech companies, you'll also want to look at the sectors, industries, and companies that are performing well right now. A market downturn can be an anxiety-inducing event as volatility goes up and portfolio returns go down. That said, focusing solely on correction and rapid price movements is the wrong way to go about this. Investing is a long-term gain and patience is vital. Instead of selling shares at a dip in order to prevent further losses, look for opportunities to buy valuable companies at relatively lower prices. If their business is still intact, but the stock price has fallen, this could signal a bargain. Thank you again for watching, and be sure to like this video, subscribe, and hit the bell button below so that you can be notified of all new videos as soon as we post them. And while I might be a new face to this channel, I'm here to stay. So feel free to let me know in the comments below if you have any questions or if there are any videos you want to see us cover. See you next time.